Welcome to the Deep Dive. Today we're cutting right through the noise of the Q3 2025 earnings call for XP Inc.
Yeah, a really fascinating one, a huge player in Brazil's financial services space.
Exactly. And their results give us this fantastic window into, well, how these high-growth platforms are navigating what is a really challenging and competitive environment right now.
For sure. The numbers dropped after the market closed on November 17th. And the whole story really is about that stubbornly high Selic rate in Brazil.
It's sitting at 15%. So our mission today is simple. We're going to pull out the critical nuggets that show you how XP is trying to decouple its own profitability from that huge macro anchor.
Let's do it.
So let's just jump right into the headline numbers because they were strong. A clear beat in local currency.
They really were, pretty much across the board. Adjusted diluted EPS, that came in at our $2.47.
Right, and that's up, what, 13% year over year?
13%. And it comfortably beat the consensus, which was looking for something closer to our $2.42.
And that outperformance carried right through to the top line, right?
It did. Gross revenue hit our $4.94 billion. That's up 9% from last year, and again, ahead of the street's our $4.64 billion forecast.
But the number that management really seemed to hammer home was the bottom line.
Oh, absolutely. Net income. Our $1.33 billion. That's a new all-time record for the company.
That is a powerful statement, especially in this environment. So what was the market's immediate take? How did it react to these record numbers?
The market took it as a very strong, very constructive report. That core message of record profits plus signs of growth accelerating in other areas, it was validated pretty much immediately.
So you saw it in the trading volume.
Yeah, you saw a big jump in volume post-call, maybe 1.5 to 2 times the average turnover. And the stock moved up nicely into the next day. It just confirmed that the platform is working, it's scalable, even if the growth engines are shifting a bit.
Okay, so let's dig into that. Let's dissect where that profitability is coming from.
Well, if you start with the margins, you see this incredible operational discipline. Their gross margin held up at 68.2%.
Which is basically flat year over year.
Exactly. In this kind of high inflation, high cost environment, keeping your margins stable like that, it says a lot.
And when you talk about efficiency, I mean, the return metrics really pop. We're looking at a return on average equity, ROAE, of 23%.
Which is strong. But the number you really want to watch, the return on tangible equity, the ROTE, that was even better, 28%.
So just for everyone listening, why is that 28% ROTE number so critical for a platform like this?
Because ROTE strips out all the intangibles like goodwill. It tells you how good they are at using their actual physical capital base to make money. And for XP, a 28% ROTE shows they are just extremely efficient. It proves management isn't just chasing growth for growth's sake. They're targeting high quality, high return growth.
Okay, so let's unpack where this profit is actually coming from, because this is where the story and the strategic pivot becomes really clear.
Right. And the standout star wasn't the volatile retail trading business that everyone associates with XP.
No, it was their corporate and issuer services division, C&IS.
C&IS was on fire. I mean, it wasn't just good. It was the main incremental growth driver this quarter.
The numbers were just outstanding, up 32% year over year and a massive 33% just from last quarter. A historic record for that segment.
It's not a side business anymore. This is a co-pilot for the whole company. Right. And it matters so much because C&IS is essentially XP's investment bank.
So we're talking corporate banking, capital markets, that kind of stuff.
Exactly. The surge came from a lot of activity in debt capital markets or DCM, corporate banking, and some pretty sophisticated hedging solutions they're providing.
So when a company in Brazil needs to issue new bonds,
XP is right there structuring and distributing that debt. And they're also building these complex hedging products for companies issuing specific tax-exempt bonds. This is high-margin, sticky, relationship-driven revenue. It's their reliable second pillar, and it is firing on all cylinders.
And they need that strength because the retail side of the business, the traditional core, is definitely showing signs of stress.
It is, even though clients are still bringing them more money.
Right. Total client assets hit our $1.4 trillion. That's up 12% year over year. And they brought in our $29 billion in new money in Q3.
And our $20 billion of that was from retail, so they hit their target for asset gathering. The assets are flowing in, which is great.
But the revenue's lagging.
Exactly. And here's where it gets really interesting. This is the financial tension you have to understand. Retail revenues only grew 6% year over year, and fixed income revenues actually went down.
Okay, so how does that happen? How can your assets under management be growing by double digits, but the revenue you make from those assets is flat or even shrinking.
It all comes back to that 15% Selic rate. It completely changes client behavior.
Because it's essentially a guaranteed high return with almost no risk.
You got it. It's like a supercharged savings account. So why would you take risk? Clients are flooding into these extremely short duration daily liquid products. Things like certificates of guarantee or CGs.
And the shift there is huge.
It's massive. Management said these daily liquid CGs now represent 45% of all new fixed income money.
45%. Yeah. And that's up from what, 25%?
Just 25% previously.
Wow. So explain why that specific product mix is so, I guess, toxic for XP's margins.
Well, it's all about the take rate. When a client wants their money to be liquid, meaning they can pull it out tomorrow, the broker, XP, can't earn the fees that come with locking money up for longer periods. So this mix shift just crushed their fixed income take rates. We're talking a drop of about 20 basis points overall.
So they're gathering tons of assets, but making way less money on each dollar or reyes that comes in.
It's a volume game right now. They're fighting for every fraction of a basis point.
Which brings us to their big strategic response, the third wave. This is their attempt to fundamentally change the whole client relationship.
Yeah, the third wave is what they're calling their agenda of excellence. And it's basically a full court press to shift from being just a place to trade to being a place for holistic wealth management.
A service that used to be just for their richest clients.
Right, for the high net worth crowd. But now they're trying to democratize it, and technology is the only way to do that.
So what does that look like on the ground?
It means they're rolling out proprietary tech, AI-powered tools, advanced CRM systems, new allocation platforms. They're even using AI to classify every single interaction between an advisor and a client.
All to let one advisor handle a much bigger book of clients without the quality dropping.
Exactly. Make the advice hyper-efficient and sticky, no matter your ticket size.
And of course, that has to translate into cross-selling. Are we seeing proof that it's working?
We are, in some key areas. Life insurance premiums grew 25% year over year. That's a good sign. And crucially, their loan portfolio, their credit business, grew 33% to $67 billion.
So that's the buffer. Credit and insurance to insulate them from the trading volatility.
That's the diversification strategy in a nutshell.
Okay, let's pivot to the investor side of things.
Yep.
Capital return. They are leaning in heavy here, which is a huge signal of confidence.
Absolutely. They did our $2 billion in buyback so far this year.
Which is significant. And then on the call, they announced a new $1 billion buyback authorization.
Plus our $500 million in dividends to be paid out before the end of the year. So that's another $1.5 billion in returns announced right there.
And it keeps them right in their target payout framework of 50-70%.
It does. But here's the interesting part. Even after returning all that cash, they're still sitting on a very high BIS capital ratio of 21.2%.
You know, that number, 21.2%, it jumps out at me. It seems a little high.
It is high.
I mean, if you're so focused on raw GOE and efficiency, why hold that much capital? Does it signal they don't have enough high ROI projects to fund? Are they being too conservative?
That's the critical question. And management addressed it. They said they have plenty of capital to fund growth in areas like C&IS and the loan book. And they reiterated their long-term target is to get that ratio down to the 16-19% range by the end of 2026.
So that implies they fully intend to deploy or return that excess capital.
It suggests the aggressive capital returns are far from over as they bring that ratio down.
Okay, and what about costs?
Well, despite all the investment in tech, Salesforce, and their big expert client event, they're holding the line. The long-term efficiency ratio target of around 34.7% is still the goal. They're betting that AI and tech will eventually give them the leverage to offset rising costs.
And what about guidance? The forward-looking statements seemed a little soft.
Yeah, a bit soft is a good way to put it. No formal numbers for Q4 or for 2026.
And they did acknowledge that hitting their previous, more aggressive 2026 growth targets might be tough now.
Right. They said they expect to be only a little bit short. So it wasn't a formal revision down, but it was definitely a way of tempering expectations, acknowledging the headwind.
And if we just zoom out, the backdrop here is still brutal. The Selic rate is at 15%. Competition is fierce, not just from players like BTG, but from the digital banks like Nubank.
Absolutely. And XP's whole argument for resilience comes down to that diversification we talked about. Wealth, advisory, insurance, credit, plus those strong capital buffers. They're betting the platform effect will win out.
The question is, how long can C&IS carry the team while retail fixed income struggles?
That is the multi-billion-dollar question.
Which is the perfect transition to our exploration of market ideals.
Let's do it.
This is not financial advice segment.
All right.
And a quick reminder for everyone listening, this part of our deep dive is purely for entertainment and discussion. We're exploring an outrageous but plausible trade idea, but please do not take this as investment advice.
Okay, so my observation is all about the valuation versus that macro headwind. XP is trading at around 9 to 11 times forward earnings.
Which is attractive.
It's incredibly attractive if you believe the Selic rate will eventually have to come down. The only reason the multiple is this low is because that 15% rate is actively cannibalizing their most profitable retail business. That's the anchor weighing down the stock.
I'm with you so far.
Therefore, the outrageous but plausible pitch is this. You go long XP stock,
Okay.
but you fund it by taking a short position in the broad Brazil equity proxy, the EWZ.
Whoa, okay, so you're shorting the entire Brazilian market just to bet on XP. Unpack that. Why hedge out everything else?
Because it turns this into a pure relative value trade. You are betting specifically and only on the easing cycle catalyst in Brazil. You take broader geopolitical and currency risk right off the table.
I see. So you're isolating one specific catalyst.
Exactly. When the Brazilian central bank finally starts seriously cutting that 15% rate, two things happen inside XP's business almost instantly.
Okay.
First, money will flood out of those low-margin, daily liquid CGU products and back into higher-margin equities, funds, and longer-duration assets. That structurally boosts XP's take rate overnight. And second, the prospect of lower rates is the classic catalyst for multiple expansion for a platform like this.
And shorting the EWZ just protects you if some broader macro event hits Brazil and sinks all boats.
You got it. It makes the trade a pure play on that internal mix shift catalyst that we know is just sitting there waiting in the wings. It's a direct bet on the retail client becoming highly profitable again.
That is a very pure, high-conviction trade. A fascinating way to look at it.
So to just boil it all down, XP hit record net income, their C&IS division was the hero, and management is aggressively returning cash to shareholders, which signals a lot of confidence.
Right. And as you're thinking about all this, here's the final provocative thought to chew on. XP is betting the farm on this third wave, on proprietary tech, on AI, on scaling wealth planning. But can that massive strategic investment truly decouple their retail profitability from Brazil's notoriously high-rate macro environment? Or are they still, at the end of the day, fundamentally chained to that 15% Selic rate until the central bank finally moves? That's the question that will define their story in 2026.